All right, let's get right into it. The big question for pretty much every investor right now is a simple one. Where on earth can you find safety and get some steady income? Well, today we're going to break down why bonds might just be the answer you're looking for in 2025. I mean, this is the reality, isn't it? The stock market is a roller coaster, and who knows where inflation is really heading. It's a tricky environment, for sure. But it's also the perfect setup for a classic investment to make a major comeback. And yeah, we're talking about bonds. Okay, let's stop here for a second because this is the whole secret sauce. It's a simple but super powerful relationship you've got to understand. When interest rates fall, the price of existing bonds, especially those with higher rates, goes up. Getting this one concept down is the key to everything else we're about to talk about. So why now? Why is this year shaping up to be a turning point? Well, think about it. After what feels like forever with the Federal Reserve hiking interest rates, the whole conversation has flipped. Now everyone's talking about potential rate cuts. And that creates this awesome two-for-one opportunity. You can lock in today's high yields, and you could also see your bonds price go up if those rates do fall. And to put a number on it, just look at this. The 10-year U.S. Treasury yield, a major benchmark, recently hit 4.8%. That was its highest point in over a decade. That peak is exactly what set the stage for the opportunity we're seeing right now. It's given investors a really fantastic entry point for both income and potential growth. All right, so you're sold on the idea, but where do you actually put your money? Let's walk through the main categories of bonds that really deserve your attention, because not all bonds are created equal, and each one plays a totally different role in your portfolio. First up, we've got the gold standard of safety, U.S. Treasury bonds. These are backed by the full faith and credit of the U.S. government, which, makes them pretty much the safest investment on the planet. If you're the kind of investor who just wants peace of mind, this is where you start, no question. Next, let's talk about corporate bonds. These are issued by big, well-known companies. Think Apple, think Microsoft. They offer a higher yield. We're talking around 5 to 6% right now for the good stuff, but that comes with a little bit more risk. It's a great choice if you're confident in the strength of America's top corporations. Then you've got municipal bonds, or munis as they're called. States and cities issue these to pay for things like roads and schools. Now here's their superpower. The interest you earn is often completely exempt from federal taxes and sometimes state taxes too. So for anyone in a high tax bracket, these can be an absolute game changer. And finally, we have Treasury Inflation Protected Securities, or TIPS. These things are just brilliant for anyone worried that inflation might stick around longer than we'd like. The value of your bond actually goes up with inflation. It's basically a built-in hedge to make sure your money's purchasing power isn't getting eaten away. Now, I know what you might be thinking. Buying individual bonds sounds like a huge hassle, and you're not wrong. But here's the good news. For most people, the answer is bond ETFs, or exchange-traded funds. Honestly, they are by far the easiest, most accessible way to get a whole diversified basket of bonds with just a single click. Okay, this table really lays it all out. These are your top 5 options, and each one is for a specific goal. So, for example, if you really believe interest rates are going to get cut, TLT is your play. Want a simple all-in-one solution? BND gives you a taste of the entire U.S. bond market. LQD is for chasing that higher yield from corporate bonds. HYMB is for that sweet tax-free income. And TIP is your inflation shield. And you can literally see the income trade-off right here. The corporate bond ETF, LQD, is leading the pack with a yield of around 5.2%. It's so clear. If your number one goal is just maximizing that steady income stream, corporate bonds have a real advantage right now over everything else. So here's the really crucial point. It's not about just picking one of these and calling it a day. It's about building a simple portfolio, a mix that perfectly matches your own goals and how much risk you're comfortable with. So let's look at a few ways you could put these pieces together. Here's a fantastic model for someone who's a balanced, moderate investor. Check it out. 40% in a total bond market fund like BND. That's your stable core. Then 30% in LQD to boost your income, 20% in TIP to protect against inflation, and, a little bit of cash for flexibility. This mix gives you a bit of everything: income, stability, and that inflation protection. But hey, maybe that's not you. What if you're super cautious? Or what if you're ready to bet big that rates are going to fall, and soon? Well, there's a simple strategy for that, too. A conservative investor might just stick with a big slug of a total market fund and some short-term treasuries. But the aggressive investor, they're going to load up on something like TLT to try and maximize those potential price gains. Before we wrap things up, let's pause on this. It's a great piece of advice from the source material, and it's worth remembering. The golden rule here is diversification. Don't go all in on one thing. Spreading your investments across different types of bonds and different timeframes is the best way to get that stability and avoid putting all your eggs in one basket. So, after seeing the whole landscape, from the safety of treasuries to the income from corporates and how you can mix them all together, the final question really comes back to you. Which of these approaches actually fits what you want to achieve this year? Is your top priority safety, income, or are you playing for that potential pop if rates fall? Thinking that through? Well, that's your next step.